On an early morning in February 2025, the entire world woke up to a statement from Washington. Donald Trump, the man who called himself the tariff man, had dropped a bomb onto the global trade chessboard with massive tariffs imposed on goods from China, Mexico, and Canada. In an instant, Wall Street was shaken. The Nasdaq index plunged by 9.5% as investors struggled to understand whether this was a brilliant strategy or the end of stability. The GDPs of America's three North American neighbors immediately declined. But to understand why Trump chose this path, we cannot look at today. We must turn back to the golden pages of American history, beginning in 1789. At that time, America was still a young and fragile nation, standing among the industrial wolves of Europe. Back then, Alexander Hamilton, America's first Secretary of the Treasury, a man with a fiery and razor-sharp mind, saw a harsh truth. Free trade was merely a toy for the strong, such as Britain, France, Germany, and others. In the historic 1791 report titled Report on Manufactures, Hamilton presented an argument that would later become the guiding principle of protectionism. A nation that wants to be self-reliant must have independent industry. He proposed using tariffs as a protective shield to defend America's young industries against foreign pressure. Hamilton believed that although people would have to endure higher prices in the short term, that was the price of freedom and growth. And more than 2 centuries later, Trump picked up Hamilton's shield from the era before 1913. At that time, the US government first imposed a 3% income tax on those earning more than $800 in order to finance war. This was America's first experiment with income tax. Later, the 16th Amendment was passed in 1913, officially integrating the federal income tax into the national financial system. The idea at the time was very clear. The government's role in society was growing larger and required a more stable source of revenue to fund education, welfare, and the military. Trump and his advisors, however, looked at the pre-1913 period as America's golden age, when domestic businesses were protected from globalization and income tax had not yet become a major burden. But does Hamilton's theory really work when applied to a tightly interconnected and globalized world like today's? The short answer is probably no. And Trump's first term actually provided quite a lot of evidence for that. During his first term, Trump imposed tariffs on steel, aluminum, washing machines, solar panels, and a wide range of imported Chinese goods, affecting around $380 billion worth of products. Supporters called it an America First strategy, but the logic behind it was essentially classic protectionist thinking. The clearest example was the American steel industry. In March 2018, Trump imposed a 25% tariff on imported steel. In theory, this should have been a major victory for domestic steel producers. The US was already the world's fourth largest steel producer, and when foreign steel became more expensive, domestic manufacturers had an opportunity to expand. Between 2017 and 2021, US steel production increased by around 5.1%, while employment in the industry rose by 6%, equivalent to roughly 5,400 new jobs. But the problem was this: 5,400 jobs were almost insignificant when viewed against the scale of the entire economy. Looking more broadly, employment in the steel industry was still far below pre-2008 crisis levels. And tariffs do not only protect industries, they also drive prices upward. Under Trump, steel prices increased by around 2.4%. Washing machine prices, another tariff-targeted product, rose by as much as 12% within just 1 year. Then other countries retaliated. Canada, China, the European Union, India, and Mexico all imposed counter tariffs on American exports. This created an even larger problem for industries that use steel, such as the automobile industry, which employed far more workers than steel manufacturing itself. Economists at Harvard University and University of California, Davis estimated that for every 1 job in the steel industry, there were around 80 jobs in steel-dependent industries. As a result, American manufacturing did not boom as expected. No major wave of investment occurred. In fact, foreign direct investment into US manufacturing fell by around 38% during Trump's first term, compared to the previous period. The failure of protectionism became even clearer when looking at the rise of China after joining the World Trade Organization in 2001. Cheap Chinese goods pushed global prices downward and caused many manufacturing jobs to leave America. The US-China trade deficit initially declined, but America's overall trade deficit increased by around 14%. Why did this happen? Because global supply chains do not simply disappear, they shift. When Chinese goods became more expensive, American companies turned to imports from Vietnam and Mexico. Many businesses began nearshoring to Mexico, while Chinese solar panel companies moved production lines to Vietnam, changed the labels, and continued appearing on American store shelves. The products stayed the same, only the assembly location changed. So why did Trump remain committed to tariffs? The first reason likely comes from America's biggest rival, China. The US viewed tariffs as a solution that could address the root of global trade problems. But the core issue was that China produced far more than its domestic consumption levels. In other words, supply exceeded demand. Chinese citizens saved most of their income, partly because of culture, partly because of decades-long policies such as the one-child policy and a growth model that prioritized investment over consumption. China's household savings rate was around 30%, nearly double that of the Eurozone, and far above America's roughly 4.5%. As a result, China became a manufacturing superpower with weak domestic demand. That excess production had to be exported to the world in the form of cheap goods. American tariffs could not change this cultural and social structure of China. Instead of solving the root problem, they merely shifted global trade from one place to another. The second reason was tied to the global role of the US dollar, and it centered on a relatively unknown but highly influential figure, Stephen Moran. A sharp economist and close advisor, Moran wrote an ambitious blueprint titled A User's Guide to Restructuring the Global Trading System. Moran's argument was blunt. America could not revive manufacturing as long as the US dollar remained too strong. Because the US dollar is the world's reserve currency, central banks, businesses, and global investors always need to hold US dollars and American bonds. This keeps the dollar strong despite trade deficits. Moran argued that tariffs could generate government revenue without causing excessively severe economic consequences. Trump clearly liked this logic very much. However, there was a major contradiction. Tariffs often strengthened the US dollar, while Trump actually wanted the dollar to weaken. For example, during the 2018 to 2019 trade war, tariffs on Chinese goods increased by around 18%, but the Chinese yuan depreciated by nearly 14% against the USD. This meant the actual increase in import prices was only around 4.1%. Even so, tariffs still contributed to higher inflation. The 2018 Consumer Price Index showed that core goods prices increased by around 0.5 percentage points due to the impact of tariffs. Moran even proposed using tariffs and geopolitical pressure to force countries into joining a new multilateral monetary agreement, similar to the 1985 Plaza Accord, aimed at weakening the US dollar. He called this idea the Mar-a-Lago Accord. Trump wanted to use tariffs as hostages. He threatened other countries. If you do not join an agreement to weaken the US dollar and strengthen your own currencies, I will lock down the American market with tariffs. He wanted other nations to sell part of their USD reserves and buy long-term US government bonds in order to keep interest rates low for the American people. Whether one agrees with these arguments or not, one thing is very clear. Over the next 4 years, America will continue moving down Trump's path. It may sound reasonable from the perspective of American businesses, since it gives them more business opportunities. But what about ordinary Americans? Even if they have more money in their pockets thanks to tax cuts, they are also paying an additional $1,000 to $1,600 per year in living costs because imported goods such as aluminum, steel, furniture, coffee, and others have become more expensive due to inflation. Perhaps Donald Trump is playing a game in which tariffs are not merely taxes, but weapons to reshape the global financial order. He wants to bring America back to Hamilton's era, where borders served as protective walls and the US dollar supported production instead of global finance. But the painful question still remains. can the American economy endure the high fever caused by inflation before Trump's strategy delivers results? And when the dust of this trade war settles, will America emerge as a self-reliant superpower or as a lonely island in a world that has learned how to survive without America? The symphony of the tariff man is still continuing, and we, the unwilling audience, are witnessing a new chapter of history being written with numbers and unprecedented risks. Is Trump leading America in the right direction? Or is he becoming isolated in a world that has learned it can function perfectly well without America?